Ticker symbol ADP is up around 25% over the past year, and today we'll be looking at a stable company with a high growth dividend. This is a profitable company which has grown its revenue by 7% in the past year, and it has faced consecutive quarters with net margin expansion. So today we'll be looking at none other than Automatic Data Processing, an HR management data company. In their annual report, they state that they operate by providing cloud-based human capital management solutions, uniting human resources, payroll, talent, time, tax, and benefits administration. So basically, they provide a software which helps streamline anything that is related to the human resources function, such as employee information, payroll management, and giving traceability to other factors such as time and benefits that they may need in the future. Now, this of course is not one of those sexy businesses that you see over there, and it's a function that you most of the time never think about, which is all the information that a company has regarding its employees. This has to be stored somewhere, and this has to be managed in some way. Their strategy for the future can be divided into three different parts. The first one is that they want to lead with the best-in-class human capital management technology that they have of course developed in-house, and every single year they're adding functionalities, they're simplifying the workflows, and they're improving the overall interface of their software. Now, number two is that they want to provide unmatched expertise and outsourcing solutions. So nowadays companies are so large that you don't only need to worry about your in-house employees. When you're hiring people in different countries, you have to worry about different regulations, conditions, and different benefits. And all of this you have to account for in a software. Well, good thing that ADP has you covered in these cases, because now they're reinforcing their outsourcing functions. And now number three is to improve their cross-selling along their clients. This of course gives you an easier room to grow because you don't have to look for different clients. You have to sell to clients that are already happy with your service and who already know you. But this company gets a lot more interesting when we dive into the numbers, as they have one of the best return on capital employed I have seen with a 53%. Now, for you to get a bit of context, usually the threshold we set for this is around 15%. Now, they have an interest coverage ratio of 14 times and a cash conversion of 95%, which is very solid. Then they have a 46% profit margin and a very solid operating margin of 20%, of course also above our threshold. And we can see that this company is not a growth monster. They have grown their revenues at a 7% in the past year, but what we like to see here is their predictability. Their margins are rock solid, they have been increasing consistently, but the revenues, their gross profit, and their net income have also increased about the same amount every single quarter. So this we love to see. And when we look at their efficiency ratios, these have also been quite stable, except for the return on invested capital and return on equity, and this is probably caused because they increased their asset base over the previous quarters. But safe to see that these are still at very solid places. Now, when we look at their leverage analysis, we can see that this company has maintained a very solid current ratio. I would like their liabilities to actually decrease over time and for this company to become deleveraged, but since their assets are above their total liabilities, this doesn't scare me. Now, when we look at their fundamental analysis, this company gets a very solid 6 out of 8 ticks, as they have very low liability risk, they have a very solid balance sheet, as they can pay all of their short-term liabilities only using their current assets. And they provide extremely consistent cash flows, and they pay dividends, and they also conduct share buybacks, meaning that they know how to use free cash flow and how to return that back to the investors. Now, they have organic revenue growth as we have seen, but they're not actually managing to translate this into organic free cash flow growth. This is consistent, but it hasn't grown over the past quarters and over the past years. The two most important factors of this slide, which are pricing power and the existing moat or competitive advantage, I'm actually unsure about both of them. I do believe that they have pricing power and a competitive advantage due to the fact that the most of their clients are actually repeat clients, their platform is completely in-house, and they offer very unique end-to-end solutions, meaning that they can increase their prices above inflation without a doubt for the next years, and this to me classifies as pricing power. The fact that they're able to retain all their customers, the fact that they are the most recognizable company in this sector by far, both of these actually represent that they do have competitive advantage. However, I do like to be pessimistic when analyzing investments, therefore I can reduce the number of surprises that I get when investing. And to me, the main issue here is that I see a lot of competition that can arise and take business away from ADP. Because I believe that everything regarding analytics in all the different industries and applications, it's a very similar business model which has been proven. However, nowadays, with all the technologies that are emerging, with the new use cases for AI, with leaner, smaller organizations that can adapt faster to these changes, I'm scared that these may actually jump in and steal a lot of ADP's clients. I believe that AI and different agents that are being sold by different companies can now transform the way that you look at your data and can even allow you to do all this process in-house without having to pay ADP for their service. I may be wrong, but I just want to point out both sides of the story. Now, when we look at their dividends, this has been growing extremely nicely for the past quarters, and we can see that their dividend yield is sitting at a 1.8%, almost at a 60% payout ratio. Now, one thing to point out here is that we can see that their DPS, their blue line, their dividends per share, has been growing at a faster pace than their amount paid. And this, of course, can only mean that their share buybacks are actually coming into effect. They're reducing the number of shares, so the dividends per share that you're getting is greater every single quarter. And when we look at their valuation, this company, of course, trades at a hefty valuation in comparison to the growth that they're offering. Currently, they're trading at a P ratio of around 32 times, which is above their average of the past 3 to 4 years. However, their free cash flow yield is sitting at around 3.12%, which is higher than the 3% long-term inflation rate, suggesting that they may be attractively valued at the current moment. Now, looking at risks and possible challenges, the main one, as I have stated, is the worsening competitive landscape. I do believe that there is a lot of possibility and a lot of breakthrough that can happen in this sector, and that can allow all the different human capital management needs to be met in more efficient, more valuable, and way cheaper ways. So I believe that ADP should get their thinking caps on and start thinking about how to stay ahead of the curve in order to retain their market leadership. Now, number 2 is not meeting performance objectives. And this is mainly due to their low growth and due to the fact that they have been depending a lot on that small margin expansion. The moment that that margin expansion starts to fade or the revenue starts to even slow down a little bit, I believe that since they're trading at a high PE ratio for their growth, this can cause major turbulence for the stock. Now, before we move on, please remember that I'm not a financial advisor and this is not financial advice, so please do your own due diligence. I do believe that you could argue that this company has a strong competitive advantage. They are providing consistent cash flows, although they're not growing, but they do offer a very high return on capital employed. So I believe that this is a good company and it will probably be a good investment, but it has low revenue growth and a high risk for new competitors. So thank you for watching. As always, this has been the Cash Flow Compounder. Join the free Patreon for extra content, and I'll see you in the next one.